I just want to welcome you to the first Climate and Your Cash event. This is an opportunity for Ottawa residents to come together and learn how to align our personal finances with our environmental aspirations, and we have a great selection of people to talk to you about that this morning. I want to begin by acknowledging that the Glebe Community Centre is located on the traditional unceded, unsurrendered land of the Algonquin and Anishinaabe people.
I will be talking about my personal experience in divesting both my banking and investing from fossil fuels. And for me, a key strategy for doing so involved moving from one of Canada's big banks, in my case RBC, to a credit union. So I'm going to be talking mostly about that today. There were two parts to my strategy. One was the easy part, which was selling off shares in both fossil fuel companies and banks that fund fossil fuel companies. The second part was much more difficult, and that was saying goodbye to RBC. So I was very comfy with RBC, but I knew I had to leave. And the main thing that convinced me that I needed to leave RBC was this report that I read in 2020 called what's it called? The Banking on Climate Chaos. And so I was really sad to see three in this dirty dozen, three Canadian flags, what shame, So we had RBC, TD, and Scotiabank on this list. And I'm sorry to say that not much has changed in the last 5 years. So I had a sort of three-pronged strategy. The first one was applying pressure. So there were many campaigns going on at that time, public campaigns, advocacy campaigns. I got involved in those, did a lot of personal advocacy with senior management at RBC. The second one was obviously getting rid of some of the problematic companies in my portfolio. I was kind of doing the rounds of local credit unions to see if I could find a new home. I was introduced to this wealth advisor at Desjardins Securities. I decided to move over to him, and I've been very happy since then. Financially, I got better returns from him than I ever did from Dominion Securities. So a few tips, like takeaways from my experience. I ended up with Desjardins. There are many credit unions out there that are doing very good things at the local level. In general, I would say credit unions are the way to go if you're wanting to reduce your exposure to fossil fuels in your banking. The second point is find a knowledgeable advisor, and so you need to shop around to get someone who is both knowledgeable but also in line with your values. Whatever you decide, if it's in a package like that, you need to dig. You need to go into what each individual holdings are. Don't just take it at face value. If it says it's a fossil fuel-free fund. And
over the last 5 years, around 2019-2020, I've been focusing on key themes for clients who actually are interested in investing in the space and divest away from fossil fuels. So I'll dive through some of these key themes, but it's important to note that all of us have certain themes in our life that we want to pursue in our investment portfolio. It is better to have those conversations, or if you have laid out those themes, if you're a do-it-yourself investor, it's better to have a definition of those themes to build a portfolio on. When we look at the foundation being built, there's three key different frameworks that we can build upon when creating this, and I will dive into each one. Number one, the easiest way is direct investment. Owning a direct company, having fractional ownership, where you're able to understand the business outcomes, the revenue that they're generating, but at the same time you gain influence by being able to vote in on shareholder discussions, proxy meetings, etc. Exclusionary screens are more applicable for individuals that might be just looking to enter the space into climate-aware investing, or that client that is just entering post-university in their first 5 years of their career where they're just looking to build their wealth. They want to have some sort of value-based approach. However, they do not have the financial commitment to own direct companies, or they are actually not aware of what is out there for them. So using exclusionary screens allows you to build a starting point. And that's what I want to recognize today. We are not looking for perfection, we're looking for progress. Perfection will come as we build and grow your wealth year over year. Impact investing takes it a step further than exclusionary screening, where you're not only looking at portfolios that are no longer causing harm, but they're actually actively driving outcomes in certain industries. How do we build? Research, research, research. So the access to information is there today. It's about disseminating that. Where do we go from there? How many reports can we read? For that investor who is partnered with advisors, the onus is on the advisor. So have the uncomfortable conversations about their approach. Ask them, what have they done? What are they researching? Have them produce something tangible for you above and beyond just a bunch of marketing fluff. When you have conversations like that, you can also then go take it a step further when you're partnered with advisors, is how do they manage risk? At the end of the day, we are all trying to manage risk. Right? So when we dig deeper and understand what's under the hood, falling for those greenwashing labels becomes impossible. Because you're able to tangibly see what you're holding, what you're invested in, how your money is growing. Bringing it all together. I mentioned this a few times, as a climate-aware investor, you have an ever-evolving portfolio.
At that shift, we focused on Canada's largest 11 public pension plans. These 11 biggest funds manage over $2.6 trillion. So if we're able to redirect some of that money that is currently invested in fossil fuels, that is huge financial leverage. At some point, you just have a pipeline that is doing nothing. So $84 billion is a fairly large risk to be taken with all of our retirement savings. I'm going to give you, in just a couple of slides, some examples of the ways that you can be involved in pushing your pension manager. If you had either a public sector pension plan, or if you are a member of CPP or LACAS. So for example, on the left actually it's the Fridays for Future collaboration, where a bunch of students all did recordings to encourage their teachers, to encourage Ontario Teachers Pension Plan to phase out fossil fuels. And on the right are the teachers themselves. Trying to get teachers into the media, writing op-eds, letters to the editor. There are lots of different ways that we can try to bring pressure to bear on the pension fund managers. And on the left, this is actually pre-COVID, if you can believe it, when people were still going to rally and demonstrate on at different, during AGMs, for example, that would be a big one, and digital actions. And I was speaking with Kate earlier about how much pressure is this pressure. But I will say that over the 6 years that Shift has been operating, we have really seen great progress. CPPIB is huge. It is the 6th largest fund manager in the entire world. Really, they own assets all over the world, so there's no way for them to diversify away from the systemic risk that is climate change. So really, they need to be investing in ways to make sure that we are avoiding catastrophic runaway climate change as much as possible. And clearly we are not seeing that so far. We were told in the public meetings in fall last year that 3.5% of the portfolio is invested. That's more than $22 billion at that time, and the fund has increased since then, so we anticipate that it's increased. But that was only fossil fuel producers, going back to Kate's point earlier. That is just this tiny part of the upstreams, that all the midstream and the downstream, let's face it. So we estimate it could be close to double that figure that CPPIB has our retirement savings invested in fossil fuels. So it's not necessarily surprising. Last month, 4 young Canadians filed a lawsuit against the investment board. Essentially, they say that the CPPIB is breaching its duties, these fiduciary duties that I mentioned, to its younger contributors by failing to, what they say is, identify, assess, and manage climate risk as a financial risk. We are, perfect, hoping to get people to essentially rally behind the applicants in the case. We have been looking for a long time for a mechanism to really force CPPIB to do the right thing, because as I said, beneficiary pressure has made a difference across the 11 funds. We've seen it in real life, but actually we're at this point where now they're only going to respond to the law, right? So we really want to seize this opportunity and make sure that they feel the pressure from everybody across Canada who supports them. So please do take the action. You can, it's super simple, and if you want to, email us and get in touch.
So I'm going to be talking about the Ottawa Renewable Energy Cooperative, what we do and who we are. In a nutshell, we are a renewable energy cooperative, as the name suggests, that finances, builds and manages renewable energy projects, solar and some wind, mostly in Ottawa and around, but also the 2 wind turbines are in southwestern Ontario. In the past, and still now, the approach is we rely on centrally generated electricity. That's fed down, that's the top of the slide here, that is fed down through transmission lines to us as consumers, so in our homes, in industry and offices. What we see emerging faster in some countries, but also here in Canada, is this puzzle picture on the bottom. So where we have, where us as consumers are also turning into generators. Maybe some of you have solar panels on your roof, so you're also a generator. You're not just consuming electricity, but you're also generating and contributing electricity to the grid. And this is really where OREC is operating, this environment, this context of what is called distributed energy resources, where you have solar on your roofs. We might have, for example, one of our wind turbines is connected to the distribution grid, so it feeds the local community. It's more resilient. It's cheaper because building renewable assets is much cheaper than non-renewables at this point. It's also much quicker. We can build renewable projects in the course of a year compared to these other kind of more centralized approaches. We have raised more than 15 million. I think the slide probably needs to be updated because we've just had a raise and continue to raise money. We've just raised $1.5 million in 6-7 weeks for the museum project and others. That's raised from our member investors. We then have returned more than $4 million to our member investors in the form of capital repayments and dividend and interest payments as well. And just to close with this, investing is super easy. We have built an online portal. You can go on our website, follow the button Invest Today, and the portal will guide you right through. To become an investor, it's necessary to be a member. The membership share is $100. It's a one-time fee.
We're going to shift a little bit away from a foregrounding of the environmental impact to a foregrounding of social impact through a housing lens. Specifically through a product that we call Housing Forever Bonds, but I think what Sarah and I will do is first introduce a little bit about where we're coming from and the housing landscape here in Ottawa. So I think it's fair to say that everybody in this room also knows that we're currently living with a housing crisis. In fact, between 2011 and 21, for every one new unit of affordable housing that we built, we lost 31 others. That's kind of where Housing Forever Bonds and our 2 organizations come in, and we'll explain a little bit about who we are. But ultimately, the Ottawa Community Land Trust, or OCLT, and Centretown Citizens Ottawa Corporation, or CCOC, are working together in response to that housing crisis and the challenge. And what we're looking to do is raise community investment to help in the preservation through acquisition and the development of new affordable housing. What's really significant is that we're both non-market actors, and while we hear a lot of conversations about development within the private sector, we really believe that it's only through non-market ownership, community ownership, that we can protect that affordability forever. and that's what both of our organizations are committed to doing. The investment opportunity. So we have come together to raise $25 million through the sale of community bonds that we call Housing Forever bonds. So this is a common marketing campaign. You'll see both organizations at the back table there. We are both issuing our own bonds, and I'll explain a little bit how that works. But of this $25 million goal, CCOC is looking to raise $15 million, the Land Trust looking to raise $10 million. Really, community bonds are a proven investment tool structured much like a GIC, predictable rates of return over a fixed period of time. You earn a financial return while also contributing to a social impact. We are together offering 4 series, 4 different options within the community bond offering, so you can invest from anywhere between 3 and 7 years, depending on the duration and investment minimum threshold from $1,000 to something higher, earning returns of up to 3.5%. Series D there is an investment that would be RSP or TFSA eligible. That one is being offered by CCOC. All of the other series are being offered by both organizations, so you could choose to invest with one or both organizations. And so that's, we still have 2.1 million from our last raise. Last year we did raise 3 million. We went out to the community wanting to raise 1.7. The community responded overwhelmingly, and we actually raised 3 million from 133 unique investors, primarily from the Ottawa region. So we really do see this as an opportunity for the community to invest in the community.